Alright, so there are like an unnecessary number of federal student loan repayment plans out there. So in this video, I'm breaking down all 8-ish plans, and you know why I say ish when we get into the video. And I'll be talking about the terms, conditions, the pros, cons, similarities, differences, all that kind of stuff in this video to help make your student loan repayment process just hopefully a little bit less confusing. Hey Wealth Builders, what's up? It's Akeiva. Welcome back to another episode of The Bemused, where we are making sense of money for the bewildered and confused young adult. If you're new around here and you're into that kind of stuff, I hope that you come join the squad by hitting that big red subscribe button, and while you're at it, hitting the notification bell so that you never miss when we post new helpful videos just like this one. So like I mentioned, federal student loans can be really confusing, and it can be a little bit overwhelming in terms of the information that's out there to sift through to determine how to best pay off your student loans. And a big part of the repayment process is actually choosing a repayment plan. So currently there are 8-ish different plans to choose from when it comes to repaying federal student loans. Now, not all 8 options are available to all borrowers. It depends on the kind of loan you have. And for the purposes of this video, I'm going to go through all 8 plans, but I'm also going to be focusing more so on plans that are relevant to direct, unsubsidized, and subsidized student loans, which is a type of loan that most of us have nowadays, especially if you are a relatively new borrower within the past decade or so. And I'll also be touching on direct parent plus loans, because I know a few of us, including myself, have those loans as well that we deal with. And so I want to make sure that I cover things that are more specific to those kinds of loans as well. There's a lot of information in this video, so if you guys see me looking down, it's because there's just a lot of information and I want to make sure that I am not misspeaking or mixing up anything. So the 8 plans are the standard repayment plan, the graduated repayment plan, the extended repayment plan, the pay-as-you-earn, the revised pay-as-you-earn. So many plans. Like, for what reason? There's income-based repayment, income contingent repayment, and then income-sensitive repayment. Are you confused yet? Because I'd be too. Some of these plans are, as they denote in the name, somewhat tied to your income, and others are not. So let's start with the first 3 plans, which do not have to do with your income. The first plan is the standard repayment plan, and this is probably the most popular plan. This is a plan that most lenders will default you to if you don't choose any other option. So borrowers who have direct subsidized and unsubsidized loan, any plus loan, whether it's a direct plus loan to the student or a parent plus loan, most student loans qualify for this plan. That includes also consolidation loans, like FFVL loans included. So this payment plan is a 10-year standard amortization repayment plan. Plain and simple, nice and vanilla. And your monthly payment amount is fixed for that 10-year repayment period. One thing you'll hear pretty often about this plan is that this is the plan that results in the fastest payoff or paying the least amount of interest over the life of the loan, which is technically true, but if you've seen my other videos on student loans and the best strategy for repaying them, you'll know why that is not necessarily the truth in a lot of cases. But if you're solely sticking to the plan and sticking to the payments that the plan outlines, then technically, yes, this plan usually results in paying the least amount of interest over the life of your repayment. And that is what makes this plan so popular. That's why they default borrowers into this plan unless you choose something else. And this is why this plan is typically available for all borrowers, regardless of the type of federal loan that you have. Now let's move on to the graduated repayment plan. And the thought process behind this plan is that your payments start off really low and then they graduate. The idea is that coming out of school, you're probably going to be making less than you are a few years out of school. So basically, the more you make, the higher your payments get over time. And the payment period on this is also 10 years, but you will pay more in interest following this plan because your payments are so low to begin with and they're not enough to really hit the principal balance of your debt in the beginning. So over the life of the loan, even though it is the same 10-year period as the standard repayment plan, you're going to pay more in interest over the life of the loan. And if you're using this for a consolidation loan, there's actually more time that you can get for the payment plan period, so sometime between 10 years and 30 years, depending on your consolidated loan balance. But for most borrowers, it's going to be 10 years. Third is the extended repayment plan. And this is where I said it's 8-ish, because within the extended repayment plan, you can have fixed or you can have graduated payments. So it's kind of like 2 plans in one. This is actually the plan that I'm on currently. I'm on the extended graduated repayment plan. So it stretches out my time period for repayment, and it also graduates my payments where they start low and then they get higher every few years. And again, all direct subsidized and unsubsidized loan borrowers and all plus loan borrowers are eligible for this plan and the 3 plans that I've kind of gone through so far. However, in order to do the extended plan, you must have a student loan balance of at least $30,000, which, if you guys have been around here for a while, know that I clearly do have over and above $30,000 of federal student loans. So the repayment time on this plan is 25 years. So like I said, it just stretches it out from 10 years to 25 years, giving you more time to pay it off. And obviously, because you're taking a longer time to pay it off, you're also going to be paying more in interest over the life of the loan if you stick solely to that plan and the payments that are outlined for you. As I mentioned on the channel before, do I intend on taking the full 25-year repayment period to pay off my loans? Absolutely not, but I'm using this plan for strategic reasons, and those strategic reasons I've outlined in the video that I mentioned before that I've linked in the cards with my strategy as to how I'm going to pay off my student loans in the fastest way possible. Alright, quick commercial break. I am here with an exciting announcement. Those of you who follow us on Instagram already know what I'm about to say. You guys already know what it is. You guys have heard this already, but for those of you who have not followed us on Instagram just yet, and if you haven't, have our handle is going to be right here in the corner at the Bemused, plain and simple. But since we started the channel, a lot of you guys have asked how you can work with us or work with me directly in achieving your financial goals. And now I am so excited to announce that now you can. So if you're ready to achieve all your financial goals, like bringing order to your finances, paying off your debt, spending money without worrying, becoming financially independent, or making some serious adulting moves like moving out of your parents' house or buying a home or even going back to school. So if you're serious and you're ready to take action to achieve your financial goals and you want to work directly with me to do that, you can schedule some time to chat with me by clicking on the link that will be in the description box below. Or if you want more information, just comment down below or DM us on Instagram at The Bemused, and we will get back to you as soon as we can. And it's important to note that I'm only working with a very limited number of people. So if you want in, I suggest you act quickly. Like I said, this has already gone out on my personal pages and on Instagram, and I'm already starting to take calls from people. So if you really want to get in on this, I suggest that you act fast. And just in case you're not convinced yet, May is my birthday month, you guys. This month is my birthday, and the best gift ever will be to see you guys take the next step in achieving your financial goals and take the next step in your financial journey. So I hope to speak with you guys real soon. So those are the first 3 plans. Now let's go into the rest of the plans, the other 5, which are based on your income in some way, shape, or form. And these are the types of plans that people who are pursuing public service loan forgiveness are going to want to look into. So now let's talk about the next 2 plans, which are the pay-as-you-earn plan, or PAYE as it's called, and the revised pay-as-you-earn, or the REPAYE as it's called. First, let's talk about who's eligible for these 2 plans. So people who have direct subsidized and unsubsidized loans, which like I said is the majority of us out there, the majority of loans out there. And also direct plus loans that are made to students. So this is where I really want to stress that for parent plus loans, there are really only 3 repayment options, because none of the other plans I'm going to talk about are open to parent borrowers. They are only open to student borrowers who have direct plus loans. Under both of these plans, your payment amount is going to be 10% of your discretionary income. And for the purpose of these plans, discretionary income is defined as the difference between your annual income and 150% of the poverty guideline for your family size and your state of residence. So that poverty guideline is going to depend on the state that you live in and the size of your family. Now, with pretty much all the income-driven plans, you have to recertify your income on an annual basis, and understandably so. Recertify how much you make and how many people are in your family every single year, because then that's going to determine what your new payment's going to be for that year going forward. But also keep in mind that you don't have to wait until the year is up to recertify your income. For example, in this current climate where a lot of people are losing their jobs, you can go ahead and recertify your income at any time, especially for income drops. You're going to want to go ahead and submit that recertification application to your loan servicer so that you can get those payments lowered. Another big point with these two plans is that if your loans are not repaid in full by 20 years after the beginning of your repayment, the remaining balance will be forgiven. So if you don't pay off your loans in 20 years, the remaining balance gets forgiven. Now, it's important to note that that is going to be considered taxable income to you. So if they forgive $20,000, $30,000 of your loans, just know that you're going to have to report that on your tax return and be prepared to foot the tax bill for that loan forgiveness. If you're not under public service loan forgiveness, let's differentiate. This is not public service loan forgiveness we're talking about. This is just standard anybody taking advantage of this plan loan forgiveness. Public service loan forgiveness is different, and any amount that's forgiven is not taxable. So what is the actual difference between the pay-as-you-earn plan and the revised pay-as-you-earn plan? So there are three major differences. One is that with the revised pay-as-you-earn plan, your loan balance is actually forgiven after 25 years for any loans that you took out for graduate school. So it's 20 years for all of your undergrad loans, 25 for all of your grad school loans. And then also a really big difference, and this is something that I actually touched on in a previous video about how Mishak and I's taxes are going to change once we get married later this year, is that with the pay-as-you-earn plan, once you get married and you're filing taxes together, it's going to affect your repayment amount. So with the pay-as-you-earn, if you file separately, you won't have to count your spouse's income with yours when you are determining your student loan payments. But with the revised pay-as-you-earn, you have to count both spouses' income, whether you file jointly or separately. So if you want to avoid having a spouse's income conjoined with yours and for the purpose of calculating your loan payments, the payee option would be the way to go versus the repayee option. A third key difference between the pay-as-you-earn plan and the revised pay-as-you-earn plan is that with the pay-as-you-earn plan, that monthly payment is actually capped to a max of whatever your payment would have been under the 10-year repayment plan. But with the revised pay-as-you-earn plan, your amount is just strictly based off of your income. So that can go as sky high above what you would have paid under the standard repayment plan as possible. So that's a third key difference between both of these plans. Now for income-based repayment. So the income-based repayment plan is actually pretty similar to the payee plan, with the major exception that consolidation loans qualify for this repayment plan. Your monthly payments similarly will be either 10 or 15% of your discretionary income. Depending on when you took out your loans will depend on whether it's 10% or whether it's 15%. And any remaining balance that you have on your student loan account will be forgiven after either 20 or 25 years, depending on, again, when you took out the loan. It'll be either 20 or 25 years, and again, you'll have to pay taxes on any amount that's forgiven after that time. Similar to the payee plan, your payment is never going to be higher than it would be under the standard repayment plan. And if you're married, your spouse's income will only count if you file a joint return. So filing taxes separately is one way to get around that. Of course, there are different pros and cons to filing jointly versus filing separately, and so you want to think through those things as well before making that kind of decision. Now for income contingent repayment. Now with this plan, your monthly payments will be the lesser of 20% of your discretionary income, or the amount that you would pay on a repayment plan with a fixed payment over 12 years. So this payment plan in particular can get pretty confusing because it's not just like 20% of this or 10% of that. It can either be 20% of your discretionary income or the amount that you would pay on a repayment plan with a fixed payment of 12 years. So there's a lot of math involved with this one. And any outstanding balance on your loans gets forgiven after 25 years. This plan, of course, has a lot of similarities to the ones before it, but one major kind of back-end loophole is that, remember how I talked about in the beginning that Parent Plus borrowers really have only 3 options. With this plan, they technically have a little bit of a workaround if and only if that Parent Plus loan gets consolidated into a direct consolidation loan, because that kind of loan then qualifies for this repayment plan. So that's kind of like a backwards way to do it if that makes sense for your situation. Again, if you don't file taxes jointly with your spouse, then you have nothing to worry about in terms of their income being lumped together with yours for the purpose of determining your monthly payments. Last but not least is the income sensitive repayment plan. Now, I feel like not a lot of borrowers, or at least, new borrowers who are in school within the last decade, take advantage of this plan because it's mostly for FFEL borrowers, people with FFEL plus loans or FFEL consolidation loans, or subsidized and unsubsidized Stafford loans, which is different from the direct loans that most borrowers get nowadays. But it's worth noting because some of them might still be floating around out there. So the monthly payment under this plan is based on your annual income, but the loan needs to be paid in full within 15 years. This one really doesn't have a rhyme or reason. Literally, they say on the website, like, the formula for determining what your monthly payment amount is going to vary from lender to lender, so there is no one way to calculate payments under this method. And like I said, not a lot of people will use this anyway because not a lot of people have loans that qualify. But that's the 8th and final repayment method. So all the information that I covered in this video you can find online at studentaid.gov. I will have a link in the description box below if you want to read through it and have even more resources to kind of guide you through this process. And also, as I've said so many times before, if you want to actually compare and contrast what your payments will be with the different student loan plans using your specific federal student loans, go again to studentaid.gov and use their federal student loan repayment simulator. I will also have a link to that in the description box below. That way it takes a lot of the guesswork out of everything and you can easily see a side-by-side comparison of the different plans that you are eligible for and your payments under each of those plans. And that will help guide you as to which repayment plan is best for your specific situation. And now, as a final reminder, like I've said before in this video and in other videos, just because you choose a student loan repayment plan doesn't mean that, one, you have to stick with it for the life of your repayment. You can change repayment plans at any time as long as you qualify for them. So it's not like a set it and forget it. You do have the option to choose different repayment plans or switch repayment plans pretty much at any time you want. And also, just because you have a repayment plan doesn't mean that you have to make payments according to that plan. Depending on your situation, especially if you're not pursuing like public service loan forgiveness or something like that, and it makes sense to just kind of pay your debt off as quickly as possible, you can always pay above and beyond the minimum that is required under your chosen student loan repayment plan. So I'm not sure if this video made you more confused or gave you some clarity, but either way, leave your thoughts and comments down in the description box below. I know this can be a really heavy, really confusing topic, and that is why the Department of Education has created these tools, the repayment simulator and everything like that, to help streamline the process and give you guys the information that is most helpful for you. If you enjoyed the video, don't forget to hit that subscribe button and also the notification bell so that you don't miss when we post new videos with helpful content just like this one. Thanks for watching, and we'll see you guys in the next video.